We learned that very early on, that your money's tied up and you've got no hope in getting it out once you're invested, unless you can transact in a secondary, or there's a liquidity event at some point.
Hello, everyone. Welcome to another episode of the Sourcing Stack. My name is Vinay. I lead investor partnerships for EMEA at Tracxn. Through this series, I speak with venture capital firms across Europe, UK, to understand how venture capital is evolving and where the next generation of transformative companies will come from. Today, I am delighted to be joined by Timothy Manna, founder of Hillside. Hillside is a Dubai and a UK-based VC with a global footprint across North America, Europe, and Middle East. Since its founding in 2013, the firm has built a diverse portfolio spanning sectors across financial services, AI, sustainable technology, recycling, multi-cloud infrastructure, and real estate. They're a very pretty sector-agnostic VC fund. Hillside takes a top-down investment approach and focuses on backing businesses solving durable real-world problems, typically taking minority stakes in companies with clear paths to scalable growth and long-term value creation. Timothy founded Hillside more than a decade ago and has led investments across a wide range of industries, combining venture investing with experience across alternative credit, technology, and real assets. Let's deep dive into the fund thesis and their investment approach. Timothy, it's great to have you with us today. Thank you so much for joining us.
Thank you for having me, Vinay.
Great. Now, to start with, the founding story and early lessons. You founded Hillside in 2013. What originally motivated you to start this firm, and what opportunity did you see in the market at that time?
Yeah, so I come from a equity derivatives background. So I was trading in the capital markets. We started to receive sort of pre-seed, seed, Series A opportunities through various channels, relationships that we have with family offices, GPs, venture funds, founders. Any avenue you can think of. We started. They perhaps assumed that the capital markets investors needed to have exposure to the private markets, but I guess what took our or piqued our interest are the asymmetric outcomes of venture, certainly in sort of pre-seed, seed, and Series A. Very different to the capital markets. So you definitely need to command a illiquidity premium, and we learned that very early on, that your money's tied up and you've got no hope in getting it out once you're invested, unless you can transact in a secondary, or there's a liquidity event at some point. So yeah, that was a hard lesson. But that being said, I guess we have an affinity to the venture space, as you said, solving real world problems, impact investing, and predominantly, making a difference through allocating capital is a lot more satisfying than just investing into the capital markets and taking clips every now and again. So yeah, I guess that's what drove us to forming Hillside and actually start allocating capital into the private markets.
Great, that's really interesting. Now, Hillside has built a very diverse portfolio across sectors like financial services, technology infrastructure, sustainable materials, and real estate. How did the firm's investment strategy evolve in the early years?
Yeah, so look, as you said, we're agnostic, and the reason we're agnostic, and I think I've carried this forward from the capital markets. I don't necessarily believe in pigeonholing yourself into one sector, one stage of the business life cycle, and that works for some people, and that's absolutely fine. But for us, whilst the diligence process can be more cumbersome because you're having to constantly adapt and evolve and sort of understand different markets that you're perhaps not familiar with. Um, and on that point, if we don't understand the market and we can't get comfortable with the business model, or it's just too complex for us, then you have to learn to say no, right? Despite the fact that on paper it may sound absolutely amazing, but we need to be comfortable internally when we're underwriting the opportunities. So I think having like a broad base investment approach for me, and my team, I think ultimately that is a better approach to take than, and better, I use that sort of sort of very openly, because it works for us, right?
Right.
Having and by virtue of being sort of open-minded, dynamic, nimble, it creates diversification across the portfolio. As you quite rightly said, we've got exposure to sustainable technology, financial services, cloud optimization, code optimization, multi-cloud, anything you can think of, humanoid robotics, right? But by having an agnostic approach, you don't sort of fixate yourself on one mandate, and I think that's worked for us. And today, we've sort of proven it across various different sectors and areas of the market.
Great. Sounds like there's been a strong emphasis on learning and adapting over time. Looking back over the last decade of investing, what have been some of the biggest lessons that shaped how you evaluate opportunities today?
Not to get oversold by founders, I think is one of the biggest things. We won't necessarily articulate that to them. We definitely, I guess, ultimately, we tend to invest. Sometimes we invest directly onto the cap table, and we would prefer that. But with the ticket sizes that we're writing, it tends to be through a syndicate, especially in recent years. And ultimately, we've learned to set our terms with the GPs, with the founders, and make them abundantly clear going into the investment in terms of what we expect from them. And reporting is a big part of that. Some of our earlier investments, the portfolio companies failed to report frequently. And when I say frequently, it can be monthly, quarterly, semi-annually. But as long as you're receiving sort of like a detailed update about the company and how they're performing, whether they're hitting their milestones, what their metrics look like. And I think a lot of founders tend to take VC capital and then just hope, especially early founders, that I guess are perhaps naive to what's expected of them. So, on that point, I think it's about making them abundantly clear, or making it abundantly clear what we expect going into investment from the founders and from the GPs.
Great. Very interesting to know these factors. Now, I'd like to go a little deeper on how you think the investment philosophy of your firm is today. Say, if Hillside actually describes itself as industry agnostic, but driven by top-down approach, how do you decide which sector or markets are worth focusing on at a given point in time?
Yeah, so we don't have a specific theme at any one time, right? We judge each company or each opportunity on its own merit.
Mm-hmm.
Yeah, I think it's as simple as that, right? We tend to look at the TAM, SAM, SOM, these metrics to understand how big our market is, how big their market is, and how realistically how much of that market they can capture, right? What their idiosyncratic edge is over their competitors. So for us, it doesn't need to be, monopolizing the market or entering a space that is completely untouched. Absolutely not. I mean, you look at the sort of the Virgin philosophy, or even, one of our portfolio companies, the easy philosophy is to essentially go into a market and do it better than the existing participants in that market. And I mean, that's a very simplistic way of approaching it, but it's, and that's what drew me to venture in the first place, right? Innovating something that is archaic, and ultimately that's what we look for. So how what idiosyncrasies a company has and how defensible that moat is, and really it's as I say, it's as simple as that. Or
True.
not, as the case may be. But yeah.
That's a really clear way of thinking about market selection. Now, just to understand, like when you evaluate potential investment, what are the key signals that tell you this business has the potential to scale and create long-term value?
Whether the founder can execute, how passionate the founder is. And I say that, and now I'm going to slightly contradict myself. I want to see that the founder has a path to reduce key man exposure, or founders. It's great. Like, if there are multiple founders in a business that understand, or even if the sole founder understands the risk that is inherent with the business being focused around them, because essentially at some point you're going to want to have a liquidity event, right? If you're going to sell this business, whether you're going to list on the public markets or whether you're selling to a strategic, yes, it's common for the CEO or the founder CEO to transition and be a part of the company, definitely, but you do not want sort of key man risk around that person. So you've got to find a way for them to build a robust business that can operate if you extract them. So ultimately, yeah, if the founder can deliver on what they're saying, can they execute? Whether the company's got product market fit depends how early it is. Whether the unit economics make sense. There's a number of different factors that I want to see checked off the list before we invest.
Right. These are pretty fundamental, I would say. Right. I've noticed about Hillside, which is a strong preference for businesses solving real long-term problems. Many of your investments seems to focus on business solving real durable problems rather than chasing short-term hype cycles. Is that a deliberate part of your strategy?
I wouldn't say it's deliberate as such. I think it's by virtue, and I don't want to virtue signal, but by touting that we're huge impact investors, we put solving world hunger. That's not it's a nice in theory, but in order for us to continue as a business, we need to make money, and that comes by investing in good, solid businesses and business ideas. So yes, it's lovely to invest into a company that is helping people and solving problems for businesses. Like, for example, we have an alternative credit lender, right? The banks do not operate well the high street banks and investment banks, and they do not operate well in our space, in this alternative credit space, this specific niche of the real estate market. But the UK has a huge housing crisis, right? Massive undersupply. Hence the current government bringing in these policies to, rectify that. So, we have a great affinity to the market, which is facilitating the development of housing in the UK. So it could be as simple as that, or it could be backing a company that is reducing carbon emissions in the concrete production space. So yeah, by virtue of being open-minded, dynamic, broad-based, it allows us to invest into companies that can solve problems, right? That can sort of help the average consumer. But again, it has to be a good business model. It has to be able to make money, and that comes down. That's what it comes down to at the end of the day.
I think that that discipline is quite important, especially in a market where hype cycles can be very distracting. Let's build on that and talk about how this plays out across different sectors. Your portfolio spans areas like AI, also multi-cloud services, robotics. How do you balance diversification while still maintaining strong conviction in each of these investments?
Yeah, so I mean, as I said, if we are agnostic, and we have a very agnostic approach. And if we focus just on one sector, then you have concentration risk, in my eyes anyway, to that one sector. So if I don't know, either margins compress or multiples compress, you're exposed to not generating very good returns in that sector. But if all of your portcos are exposed to that one sector, then you've got big problems. And it's nice to have a diverse portfolio. That's always, I'll never forget, and I'm paraphrasing what Warren Buffett said in one of his books, but it's nice to be diversified within a basket of the same assets or something, So essentially, we are diversified across seed, pre-seed, Series A, which is one section of the business life cycle, but it's across various different companies and sectors. So yeah, as you said, we aren't chasing the AI hype, but then again, we've got that wrong. We got offered Anthropic at 5 billion post money, and we were sitting there thinking, look, there are a number of competitors in this space. How much of the market can they actually capture? They've recently raised a 380 billion value, so we got that very wrong. So we are human, and we are humble enough to admit when we've perhaps made mistakes, but then that educated us moving forward and helped us cultivate a different approach. And last year we backed a humanoid robotics business, which was later stage venture than what we typically do. And they're doing very well. So it's nice to see that you learn from those mistakes, and you can sort of you can make adjustments to your investment philosophy and strategy, and fingers crossed it comes off.
Right. You mentioned about that humanoid robotic company. So is there an uptrend in these areas, like especially the humanoid robotics?
Yeah, so this specifically, this company called Agility, the realm was led, I believe, by SoftBank and NVIDIA. And look, like anything, the warehouses are, or can be an unsafe place to work. Like, people will be up in arms with, AI or LLMs replacing perhaps certain areas of the market in terms of employment, and they'll say the same for warehouses, but warehouses can also be a dangerous place to work. So as we saw in the industrial revolution, the technological revolution, the artificial intelligence revolution, new jobs are created elsewhere anyway, right? And that will happen. just it's human nature. We evolve. We're innovative. We think of new ways to start businesses or whatever, and new companies or new employment will be created elsewhere. So I think that that's very impactful, backing a company that is reducing the exposure to an unsafe environment for people working in warehouses, for instance, right? And this one company specifically, Agility, has contracts with Amazon, Mercado Libre, which is like the Amazon of South America, with Toyota Canada, and this is all public information anyway. So yeah, we believe it has a bright future, and I definitely think it is solving a problem. The people contest that, and that's fine. But I think it will come out in the next sort of 5 to 10 years where those new roles will open up and how things will evolve.
Right. Excellent. Now, Hillside has also been active in areas like property-backed lending and alternative credit platforms. What makes that segment attractive from an investment perspective?
Yeah, so I think this is a company that I'm very fond of. So Easy Money, which is partly Easy Group. We anchored that investment round in 2018, early 2018, and ultimately their core premise is to lend to asset-rich property professionals in the UK that wouldn't typically get lending from the banks, and if they would, it would take ages for the banks to underwrite. And we understand that it's a lot of these deals are time sensitive, right? You've got carrying costs and various other costs that exist within real estate development, fix and flips, any form of bridge lending. There's a reason that it needs to move quickly, and we understand that. And I think that's the asset class and the nature of that business, right? But the actual underlying business itself, Easy have an investment platform, and the peer-to-peer market was considered, I don't know, there were a couple of bad actors, and I think the nature of it seemed sort of negative, and I think we've sort of changed that, especially in our specific niche. We're all senior secured lending, PGs, debentures. We underwrite the assets. We get external valuations done on the real estate or the projects by Red Book valuations, which are real estate valuations in the UK, RICS as it's called. And ultimately, our average loan to value across our book is around 55%. Everyone said when we entered the investment, or the feedback that we got in the market was, look, you'll probably do well because everyone knows the Easy brand, and they'll tend, it's a mass consumer product, so people will, if they are looking to invest in peer-to-peer lending, they probably will come to you. But it'll be really hard to get past 50 million. We got to 50 million. Everyone said, okay, great. It'll be really hard to get to 100. Achieved 100. Next, it was really hard to get to 200. We now got 300 million under management. We've written nearly 700 million pounds worth of loans since launching the platform in Q1 2018, and this is all without institutional financing. So I think this is, I think for me is I take pride in the fact that we have gone against the grain, ignored the sort of general consensus, and had conviction in this business, and now they're generating considerable free cash flow. We've returned our investment twofold, so and that's a rarity, right? Not many early stage investments generate free cash flow, but B, distribute free cash flow. So we're in a very unique position, and I'm very happy with the problem that Easy are solving with regards to funding UK developers, small mid-cap developers who wouldn't typically get this financing from the banks, and also the bridge market as well that we currently operate in. Again, it is solving problems, and it's providing that short-term capital that people need to undertake whatever business opportunities they're looking to do, and that helps employment. There are many sort of issues that you're solving or that this company's solving. So it's one I hold close to my heart.
Great. That was a really fascinating journey. I mean, so you typically take minority stakes in companies generating between $10 million and $250 million in revenue. So at that stage of growth, where do companies most often need the most support from investors like yourself?
So yeah, I mean, and I don't know, that's come from our website. So we do like to see momentum, and that typically comes when the company's reached a reasonable ARR or revenue run rate. But we have participated. I mean, we invested into Easy when they were sort of pre-revenue. We invested into our code optimization business, Tech, when it was doing, I think, $1 million in ARR. So look, we are open-minded. It's not sort of fixed at $10 million. But I think, look, at that level, the utopia of investment is to invest, the company perform well, the founders or general partners of the VCs that you're investing through provide a detailed report as frequently as possible, so you know that they're hitting their milestones, but that's not always the reality. So what we have done for portfolio companies is provided customers to the businesses. There's been some overlap with some of our portfolio companies where we've introduced them to one another and they've actually utilized their product or service. We've introduced capital to various portfolio companies, whether that's equity or debt, and we've provided strategic advice. I mean, the beauty of what we can give, and it's not always, it doesn't always work out like this, because as you probably know, there are multiple ways to skin a cat in venture, and what didn't work for us with one portfolio company may work for another portfolio company. However, what we can do is furnish them with the experience that we've had, and I think that those battle scars have facilitated us with the knowledge to sort of share with founders and arguably other GPs in terms of what works and what doesn't work, and what we've seen not work. But as I said, what doesn't work for someone may work for someone else, so you can only try. But if it then doesn't work again, it's sort of the I told you so situation, which yeah, we have to be cognizant of. But yeah.
Right. Yeah, great. Now, from a global investing perspective, given the current economic environment, are you seeing more caution from founders and investors, or more opportunity emerging from the market reset?
Yeah, so I definitely see founders looking to extend runway. Being under pressure to raise in certain environments can be a challenge. But to be honest, as we're seeing, obviously subject to what's going on in the Middle East right now, and if that does get resolved before CPI impacts the central bank's ability to cut rates, that aside, we actually saw founders be able to raise during this rate hike cycle, which I found interesting. So it definitely, we're definitely seeing more activity and more froth come into the markets in sort of 24, 25, 26 than we saw obviously post 2021. 22, 23 was a lot harder. And you're even seeing it in the capital markets. I mean, that you've got the S&P trading at 26 times earnings or something crazy, and so I mean that does scare me slightly. But people are continuing to raise money, and there is an appetite for venture right now. That's what we've seen anyway. I mean, you look at Andreessen; they just raised a $15 billion fund. So I think it's subjective. It's where you are positioned as an investor and what stage you're investing at. I think will vary your perspective on the markets. And I know that's a bit convoluted, but that's just the way I think we see it anyway.
Right. Now, a quick advice to the founders. For founders listening to this conversation who may want to work with Hillside in the future, what makes a company stand out to you immediately?
Passionate founder. Now, I know what I said earlier is from the perspective, we want to see them reduce their involvement while the company continues to sort of scale on its own or as its own entity without the founder having to drive it forward. But in the infant stages, certainly pre-seed, seed, Series A, we want to see a very passionate founder that knows the market inside out, that can execute, that understands the unit economics of their business. And I think ultimately we have a checklist that we have to be comfortable with before we actually commit capital. And I think that having a passionate founder is key. But also, it goes without saying that their business model and their uniqueness, their idiosyncrasy of that business needs to be defensible for us to participate. We don't want the risk of competitors being able to sort of move into the market. Now, someone going, oh, we're implementing AI into this business, and the only real advantage they've got is first mover. That's not really going to cut it for us. It's not something that we're going to be excited about participating in. They have to have a really core defensible moat within the business, and that founder needs to truly believe in that for us to get excited about something.
That's incredibly useful for founders listening in, especially around what actually captures investors' attention early. Now, and to close on a forward-looking note, 5 years from now, what would success look like for Hillside Enterprises?
Well, I'd love to see a number of our portfolio companies head towards a liquidity event. That would feel like a big win. Hopefully a successful one at that. And then just to continue doing what we're doing, making a difference in industries, innovating, as I said, industries that perhaps could do with it, making a difference in people's lives, making a difference in founders' lives, in consumers' lives. Allocating capital that way, I believe, is a fitting and a purposeful career path. So yeah, that's what success would look like. Liquidation events and or liquidity events, should I say, and continuing to do what we do.
Great. Thank you, Timothy. This has been a really insightful conversation. I think what stands out clearly is Hillside's disciplined approach to investing, focusing on real durable problems and building long-term value across cycles rather than chasing short-term trends. It's actually interesting to hear how you combine global perspective with top-down lens, and while you're still staying very grounded in fundamentals and execution while evaluating businesses. Thank you again for taking the time to share your journey, your investment philosophy, and your perspective on where the market is headed. And to everyone watching, thank you for tuning in. We will be back with more conversations with VC funds across Europe and beyond. Thank you.
Thank you, Vinay.